Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review for the week ended 11th of July. From our research desk this week, we had all these fantastic stories on why most stock market gains happen overnight. A story on gold and recession, emerging market breakouts, India versus US 10-year yields, silver's wild moves, shocking growth of global money supply, assumptions in the market, what role they play, how large caps can outperform small caps again, what can India learn from Vietnam's story, and markets falls are normal and why you should not fear them. These were some of the content stories that we did this week. They are available at the Weekend Investing blog, in the Weekend Investing newsletter, on the Weekend Investing app. Do go through them. Team works very hard on these stories, and we would like more and more people to make use of it. Disclaimer as always, please read the disclaimer fully, understand it fully, and only then go forward in this video. Uh, if you haven't subscribed to the channel so far, please do so. It will be our great privilege to have you as our subscriber. Nifty this week, disappointing week, 1.22% down this week, is breaking down below the 20 DMA. No danger yet of any major downtrend, but the current gain that we had going above this congestion zone, that has been lost, and perhaps we will again get stuck in this congestion zone going forward. On the weekly chart, it is more evident that we tried to go higher and perhaps even challenge this, but maybe there is a wait that needs to happen, more consolidation here, and then perhaps going forward. This base that we made here in this congestion zone of nearly 24, 300 or 400 at this base, I think that will be very crucial going forward. It's about 700 points away from where we are right now. So not so much to worry as of now. Mother market, US market, absolutely flat this week. You can see the doji star there. Perhaps it is making a top. I don't know. Only if it breaks, let's say below the 2 week low, will there'll be a first sign that perhaps the bull strength of a new breakout is not sustaining. That will be a point to watch out for in the coming weeks. Gold is up. Gold is up 0.93% this week, 9,800 rupees on the gram. Gold is also consolidating since April. And if you will see this rallies of the last year and a half, you're finding that gold runs up, consolidates, runs up, is consolidating, and naturally the next expectation is that the run up will happen. In each of the past run ups, it has gone 10 to 15,000 or 10 or 1,000 to 1,500 rupees uh, per gram ahead, 10,000 rupees per gram ahead. So 1,10,000 or so could be a natural sort of expectations once the move starts, which currently is consolidating. Dollar index not yet breaking down completely, 0.91% up this week. Very surprising that dollar index also moved up and gold also moved up this week. If dollar index will strengthen even more, perhaps there will be more pressure on gold and emerging markets as well. So dollar index going up is not good for neither for Indian markets nor for gold. On the benchmark indices overview, all indices down. Small caps, in fact, hit the least at 0.6%. Mid caps hit the most at 1.5%. Nifty, Nifty 500, and Nifty Next 50 were in the middle at around 1 to 1.2% down for the week. If we see the sectors, defense sector lost the most ground this week, 4.8%. Uh, Capital markets that have been roiled due to the Jane Street saga, down 3.4%. IT stocks, perhaps not very happy with TCS numbers, and they were sort of uh, maturing in terms of their rally also before TCS. The 3.8% down on that. Media also down 3.3%. These were some of the bigger losers. Only FMCG stood out. So there seems to be a complete defensive uh, mode of play right now in the market where FMCG, pharma, although down 0.7%, but stocks were not really going down with the market. And you also had some small gains in MNC stocks, and private banks also held well. Tourism stocks also managed to have a positive outcome. On the sectoral momentum score table, we see banks at the top, financial services are next, private banking is next, capital market which was at the top, but in the very short term is getting a bit disturbed here. Tourism is up there, MNC stocks are up there. So these are basically banking and financial is where the you can say the top ranking of momentum is there currently. In the bottom space, you can see media, IT, energy, auto, real estate. They are all at the bottom. So no great shakes momentum is happening here. But in some of these sectors like FMCG, like perhaps even central PSEs, some green shoots are there. Tourism, MNC, some of these sectors perhaps can come up as more durable rallies. Right now, only on a very short term basis, they are showing some green shoots. What has been shot down in the very recent weeks and months is capital market, of course, defense, real estate, and IT stocks. This is the makeup on the momentum score front. On the weekly advance decline stats, you can see the bias is on the red. So 74% to 58% declines across the board. Small caps actually losing less, larger caps losing more. So more declines in the large cap space. If we see the percentage of stocks outperforming benchmark, all of them actually not doing so well, all below or around 50%. So most uh, of the indices that are out there, uh, very few, or let's say majority of the stocks are not outperforming the benchmark. And that is also reflected in the monthly. And even if you go out 1 year, you are able to see that even over a year, not a single index is there where even 50% or more stocks are outperforming the benchmark. So overall, there's not so much of the strong undercurrent that we would want to expect from the market. In terms of the drop from 52-week highs, um, again, large cap space is the only space where the damage is still contained. You have almost 74% of stocks within 20% from their 52-week highs. The rest are, of course, 20 to 40% higher. But the other spaces that we have, whether it is Nifty Next 50, whether it is mid cap, small cap, micro caps, you can see there is a substantial number of stocks in the 30 to 50% drop range. So 18% here, 22% here, 29% here, and 37% here. Stocks which are down 30 to 50% from the top. And so effectively, the market has not really come back as a whole, but the headline index numbers have improved. So the portfolios are still bleeding, but it doesn't look like that way when we look at the headline index. Is the trend improving or declining? So on the 50 DMA, the trend is flat. 77% of CNX 500 stocks are above 50 DMA, which is not a bad sign. Uh, that is not, I mean, usually when the markets will start to fall, the 50 DMA percentage stocks above 50 DMA will fall fast. That has not happened yet. So we are still holding on. And we are seeing that in weekend investing, absolute strategies also, no strategies in any kind of cash. Everything is allocated. So the market is still holding. On the 200 DMA, there is a small slide down, but we are still at 54%, not a great number. So only 54% stocks are above the 200 DMA. But somewhere in the middle range of the uptrend, where it is not a strong uptrend, but it is not a weak downtrend either. If we do the trend check for sectors, uh, and let's say 200 DMA, you can see on financial services and private banks, the same which were leading the momentum score also have 90% and 80% of stocks within that index beating the 200 DMA. Some decent numbers are also there in metals, PSU banks, commodities, infra services, consumer durables, and manufacturing. The entire index is at 54%. So 54% of the 500 stocks of CNX 500 are above the 200 DMA, which by itself is not a great number. But if we see the ones that are reeling below, you can see IT is only 20%. So only 20% of IT stocks in the IT index uh, are above 200 DMA, only 35% of PSEs, and only 40% of real estate. So these segments are still not yet really catching on, and the strength currently still lies with financial services and private banks, as we can see. In the FIDI stats, we had very benign 4 days on the FII stats, but on Friday there was a big down move. and a big uh, sort of a, down 5,000 crore uh, candle is there. And if we see the DIIs also, four days were decent buying, but on the fifth day about 3,500 crores. So almost matching the FII numbers on the other side. For the last 1 month cumulative, FIIs are now back again in the negative. So negative 1,200 crores over the last 30 days for FIs, whereas 56,000 crores have been put in by DIIs in the last 30 days. So DII funds are pretty much sustaining the market, and the silver lining is that FIs are not selling much. If they're not buying, they're not selling much either. That is the outcome of that. So we are somewhere, in not in such a bullish territory, I would say. Although the index is very near the previous highs, um, it is somewhat deceptive to some nature, where some stocks have really outperformed and the majority of the stocks are not, as we saw in these statistics, close to the benchmark index. And a lot of stocks are still below 200 DMA. So I think we still need to hang in there in terms of waiting for market to consolidate more. Um, Perhaps to 2025 may remain this way. Perhaps the larger moves will start to come once the US flows, which depends on the interest rates there, all those things get sorted out. The tariff uh, sort of confusion still continues. I think 2025 will remain a bit choppy like this, but that could just be my guess. Do write in the comments what is your thought process on the markets now, and do of course do give us feedback on this entire presentation. What statistics you like, what you didn't like. If you would like us to add some more, do give your suggestions. We'll certainly look at them. And thank you so much for joining, and do watch this weekly. Thank you so much. Bye bye.